and other crypto-related stocks, which had been beaten up very badly going into Wednesday. They had a dead cat bounce on Wednesday night following the lead of NVIDIA. And then when the U.S. markets opened on Thursday, they gapped up, and much of the earlier gains or overnight gains were still there. But then relatively shortly thereafter, I forget how much time the market spent up, maybe an hour or so, we had a huge reversal. NVIDIA ended up negative on the day by a couple of percent. But other tech stocks just got obliterated. Everything related to AI and nuclear power, we saw huge drops. And of course, the crypto market got obliterated. All of the stocks that are related to crypto, whether it's these crypto Bitcoin treasury companies or Ethereum treasury companies.
Gold's 2025 domination is not a speculative rise. World's oldest currency was structurally repriced. Gold rose dramatically in a climate when every other major asset class failed for the first time in decades. Acting as a reserve asset, gold outpaced the S&P 500, NASDAQ, global stocks, bonds, and cryptocurrencies, with year-to-date returns over 50%. Gold maintained solid despite global market turbulence, as investors sought something to absorb liquidity shocks and monetary mismanagement. Peter Schiff emphasizes this fundamental shift. Gold goes beyond increasing. It is recovering the role central banks, institutions, and retail investors abandoned for digital narratives. Silver has also changed paradigms. Silver now reflects the full scope of global monetary risk, unlike in the 2010s when it lagged behind gold. The metal's multi-decade highs, around $50, indicate that industrial demand, investment flows, and structural supply shortages are converging, not speculative exuberance. In 2026, Schiff predicts this dynamic will intensify. An unprecedented increase in private investor demand as the globe digests gold's 2025 dominance. Gold has beaten equities, smashed the crypto complex, and delivered returns that bonds, especially treasuries, cannot match. This makes the market structural, not speculative. The repricing of risk, global move out of sovereign debt, and central bank bid have laid the groundwork for more upside. Schiff's message is straightforward but powerful. Gold is again the only worldwide reserve asset, and silver, always more volatile, is poised to capitalize on that recalibration. Early investors who recognize this transition will benefit most in 2026. Peter Schiff will explain these dynamics soon. From the liquidity squeeze that hammered equities and precious metals to the yen carry trade, unraveling to gold and silver's resiliency amid global volatility. His collapse goes beyond price. It shows the forces that will direct capital flows. His description gives a glimpse of why the metals market in 2026 may be different from the preceding decade. Stay with us through the complete analysis to comprehend global finance's transformation. If you want comprehensive data-driven examinations of gold, silver, and macroeconomics, please like, subscribe, and set on notifications to never miss this content.
Percent in the aftermarket on Wednesday, and so the whole NASDAQ was following the lead. Bitcoin and other crypto-related stocks, which had been beaten up very badly going into Wednesday, they had a dead cat bounce on Wednesday night following the lead of NVIDIA. And then when the U.S. markets opened on Thursday, they gapped up, and much of the earlier gains or overnight gains were still there. But then relatively shortly thereafter, I forget how much time the market spent up, maybe an hour or so, we had a huge reversal. NVIDIA ended up negative on the day by a couple of percent. But other tech stocks just got obliterated. Everything related to AI and nuclear power, we saw huge drops. And of course, the crypto market got obliterated. All of the stocks that are related to crypto, whether it's these crypto Bitcoin treasury companies or Ethereum treasury companies, or exchanges or things that that trade Bitcoin or stable coins or crypto in general, just got clobbered on Thursday. And I think it was a very significant reversal. Gold held up pretty well, as did silver, although both gold and silver got hit hard overnight, although they paired those losses. Gold was down back below, or not quite. Gold didn't get below 4,000. In fact, it never did. It was down about 40 to 50 bucks, but it was always above 4,000. And in fact, it closed the day down about $14 at about 4,062. So holding like a champ at the $4,000 level, still off a bit on the week. But given this mass liquidation, which I think looks like it was liquidity driven, I think people are getting some margin calls. I think there's some forced selling. And that may have been why the gold stocks got hit so hard yesterday. Even though gold was not down very much, maybe less than 20 bucks, gold stocks were down 4% or so. In fact, that's how much they were down on the week about. The GDX, GDXJ were off about 4%. Pretty much all those losses being clocked yesterday. In fact, we made up some of those losses today. So actually it was a bigger drop, or there were some losses earlier in the week. Silver was down over $1.50 in the early morning hours, got below the $50 level, came back up to about $50 late in the day. In fact, it did trade back above 50 intraday, but it looks like it's settled just below 50. I mean, I'm not sure the exact settlement yet because I'm recording this this pretty soon after the close, so I'm not sure where the settle is. But right now I'm looking at about a dime below 50, 49.90. But again, holding near $50, that's the breakout level. That's the old double top. So gold and silver holding up very well in the face of all of this market volatility. Part of it, though, is coming out of Japan. Part of the liquidity squeeze, the yen carry trade. The new Japanese government announced a massive new fiscal stimulus where they're going to be mailing out stimulus checks and doing some other stuff, right? And, these stimulus plans are all misguided. They've been making lots of mistakes in Japan, just like we make mistakes here. Although the Japanese stock market has been doing great, although all the other stock markets got clobbered last night as a result of this and what's been happening to Japanese government bonds. In fact, the 10-year JGB, the yield got above 1.8% yesterday. It backed off a bit today. I think we settled at about 1.77. But 1.8 was like a 20-year high. I forget exactly. But I've been talking on my main podcast at, the Peter Schiff, not on so much on the SchiffGold, although I probably mentioned it. But I've talked a lot about the yen carry trade and the blow up of the Japanese government bond market. And that's what's going on. Because when this started, the yield on 10-year Japanese government bonds was less than 50 basis points. And I remember when, they had a line in the sand there, they were trying to hold the yields below 50 basis points. In fact, they were quite a bit below at one point. And now they're more than triple that. I think once we get above 2% in the 10-year Japanese government bonds, you're going to see, some real fireworks in the markets, not just in Japan, but all around the world. But it was interesting because the government came out and said that even though they're doing this massive stimulus, they don't anticipate increasing the issuance of, Japanese government bonds. Well, how can that be, right? How are they going to run bigger deficits and not have to issue more bonds to finance them? And what I'm thinking could be the situation, and I don't know because the Japanese have been a bit reluctant to do this, but it's the smart move. Maybe instead of selling Japanese government bonds, issuing new ones, they'll just sell some U.S. treasuries because they've got over $1 trillion, right, losing value. The best way the Japanese can stimulate their economy is by selling treasuries, not JGBs. See, because if they run bigger deficits, that's going to spook the bond market even more. That's going to weaken the yen. That's going to push up import prices. It's bad news. And the yen is already weak, near 160 against the dollar.
Strengthening this until this year. Schiff's comment regarding forced liquidations shows how leveraged the market is. Mining shares were hit hard by margin calls despite gold's little drop. Silver fell below $50 before recovering, showing that physical demand and long-term positioning remained solid despite short-term volatility. Divergence matters here. The metals maintained firm as paper market instruments took the selling pressure. This pattern shows institutional deleveraging, not underlying weakness, is causing short-term instability. Schiff links this to Japan's liquidity constraint as rising JGB yields threaten to unravel one of the most significant global finance channels of the last 20 years. Schiff's next major topic begins here: the consequences of Japan selling U.S. Treasuries instead of JGBs. Rising Japanese yields, fiscal stimulus supported by foreign reserve liquidation, and the yen carry trade unwinding all destabilize U.S. bond markets and shift them toward real assets. These factors explain why precious metals have survived broad selling pressure. A permanent environment shift is described. It is structural and sets the stage for his next point concerning Bitcoin's accelerated collapse, gold's rotation, and institutional transformation.
They can solve their problems by selling treasuries and then selling the dollars they get when they sell treasuries to buy yen, and then they can send out that yen to Japanese citizens. And that's great because that'll strengthen the yen, which will give the Japanese more purchasing power, which will help bring down their import prices. And so that's the best way to stimulate the economy without hurting the economy, because if they stimulate it by selling more Japanese government bonds, then you're going to weaken the yen, you're going to have more inflation, you're going to have more upward pressure on yields. So selling treasuries is great for Japan, but it's going to torpedo the U.S. economy and the U.S. financial markets, because selling treasuries pushes up our yields, right? And it pushes down the dollar. And it also causes an unraveling, more so, of the yen carry trade, where people who borrowed yen to buy risk assets in the U.S. or even treasuries now have to reverse those trades, sell out their risk assets to buy back their yen. So some of that pressure may already be what was coming down on the U.S. tech stocks, and we'll see what happens next week as we continue and build on what happened this week, which again was a very significant week in the markets. But one of the reasons I think it was very significant for gold too is the blow up of Bitcoin, right? And because Bitcoin has been overshadowing gold for years, right? It's been stealing all the headlines, stealing all of gold's thunder. And I know it's been very frustrating to the gold bugs to just watch all the crypto bugs getting rich while, gold was going sideways. And in fact, it was, the years of sideways action. Gold peaked out from its big run from sub 300 in 1999 to 1900 in 2011. From 2011 to 2014, gold really didn't go anywhere because it didn't get above 2000 until 2014. And that was about the peak from 2011. So it was during that dozen-year time period where gold holders were frustrated by the failure of gold to make any new gains, that Bitcoin was able to really steal the show by convincing a lot of people that it was the new gold. After all, look at this spectacular appreciation. Bitcoin keeps going up. Gold doesn't go anywhere, right? So Bitcoin is taking gold's place. It's better than gold. It's gold 2.0. And the markets kept, reinforcing this up until this year, right? This year, gold is up better than 50%. And I don't know, Bitcoin is down over 5% or something like that. Bitcoin is 85,000 as I'm talking. When I recorded the podcast last week, it was still over 100,000. Bitcoin dropped 10% on the week, or maybe it was, just below. The low today was under 82 before we got a rally back. No, except below 81. Bitcoin earlier this morning got to 80,537. That's on Bitstamp. We were at 126 not too long ago, like a month or something. So you're talking about a 35% decline in Bitcoin in dollars. Against gold, it's 43%. This is a massive bear market. But Bitcoin is far more correlated with tech stocks than gold. And if tech stocks have peaked, if we're going to have a pullback, a correction that's just getting started in tech stocks, the bear market that is already well underway in crypto is going to get a whole lot worse. In fact, it was crypto that broke first. Crypto was a leading indicator of what was going to happen in other risk assets, because Bitcoin is the riskiest asset of them all, and all this crypto, right? Because it's all nothing. It's just all pure hype. And in fact, I mentioned this, and I've been pointing the weakness of the crypto-related stocks, which have been obliterated. MicroStrategy is down 70% now. It was down, I think, 15% this week, but it's down 70% from its high a year ago in November of 2024. Following the election of Trump, it had a big spike, but it's now down 70%. But all of these crypto stocks are getting decimated. In fact, the worst one that I've seen is Nakamoto. Symbol is NAKA. This is a Bitcoin treasury company that was launched this year in May. And it was launched while I was at the Bitcoin conference in May. 35,000 people. And one of the hot topics was buying into Nakamoto, because the guys that run that conference are the ones that were behind Nakamoto. And of course, it's Nakamoto after Satoshi Nakamoto, right? And it's a Bitcoin treasury company, which means it's nothing, right? There is no viable business model for Bitcoin treasury companies. All they do is buy Bitcoin and hold it. I mean, what kind of business is that, right? Anybody could buy Bitcoin. I don't have to invest in a company to buy my Bitcoin. If I want Bitcoin, I could just buy it. I mean, it's all a bunch of nonsense. But this stock came out and it was over $30 a share.
From Schiff's conclusion, his 2026 vision is radical yet anchored in market behavior. He believes gold will win the worldwide flight to safety as Bitcoin's multi-year frenzy fades. Institutional investors who avoided gold during the digital gold narrative are now seeing it behave like a reserve asset. Late entry crypto investors are finding that liquidity has dried up. Schiff notes that Bitcoin whales from a decade ago have left. A fragile ecosystem reliant on debt, ETF flows, and corporate treasuries with decreasing risk tolerance remains. Central bank behavior supports this trend. For the first time in decades, global central banks have more gold than U.S. treasuries, a major rebalance. Central banks that aggressively acquired gold in recent years beat those that didn't, driving additional countries to accumulate metals. Schiff claims that sovereign balance sheets are treating gold more like baseline collateral than speculative assets, turning it from a hedge to a core reserve component. Meanwhile, global bond market structural pressures increase. Treasury bonds are no longer the global safe haven as yields rise and deficits grow. Japan's probable sale of U.S. treasuries to fund its budgetary policies highlights this vulnerability. The shift toward assets that cannot be created, inflated, or politically manipulated is strengthened by every percentage point increase in yields, which devalues trillions in sovereign debt worldwide. This realignment benefits gold and silver. Central bank accumulation, Bitcoin confidence collapse, sovereign crisis, and risk repricing point in one direction: multi-year precious metals bull market. Schiff thinks 2026 will be remembered as the year investors discovered financial promises were unreliable and returned to physical assets. Data from 2025 reveals the transition is underway. Like the video, subscribe to the channel, and comment if you liked this analysis. Thanks for watching, and stay tuned for more gold, silver, and global financial analysis.